Okay, hi everybody. Good morning. Welcome to OurCrowd University. I appreciate the fact that you're here because I'm aware of the tremendous opportunity cost of being here this morning. The content outside is just fantastic, and I hope you get an opportunity to see all of that later on this morning and this afternoon. I appreciate that you've come. The purpose of this track, OurCrowd University track, is to give you very real hands-on skills in first-time investment into startups. To that degree, I really invite questions throughout the presentation. If anybody feels that something's not clear, please just put up your hand. If it's not clear for you, it's not clear for 20 other people. So let's really try to iron that out. The goal is, as I said before, to give you practical skills that when you walk out of this room, you understand term sheets better, you understand valuations better, and through that, you'll become better investors and able to look at opportunities in a better, more coherent way. The session is going to be breaking out really into two parts. The first is talking briefly about the case for invested into private companies, okay? And then we're going to use the term sheet as the skeleton structure and the base for the rest of the presentation, as I'm going to describe some of the economic and control provisions of what we institutional investors look at when we make investments into early stage startups. The case for investing in technology companies is actually very simple. If you go back just 2 decades, you'll find that only 1 out of the top 5 companies in terms of market capitalization was a technology company. Today, all of the companies are technology companies, and not only that, their trend is growing, but what you find is that it's too late to get into these companies once they've already hit the public markets, okay? If you look, for example, at Apple's recent announcement of a $1 trillion valuation cap, these numbers are huge. Now, I'm not going to imply that you can't make money at these valuations, but the value capture has been taken by the private markets. Over here, it used to be that if you invested in private companies, there was a tremendous amount of wealth creation whilst the companies were private. However, once they hit those public markets post-IPO, there was another tremendous amount of value in these gray blocks over here that you could see that was captured by the public market. That trend has stopped. Companies today are staying private longer. They're raising more and more capital, and this is going to be really the focus of the next session in the afternoon today, talking about these mega rounds and how companies are staying private for longer, pushing out the IPOs. And what you find is that all the value capture is being done whilst the companies remain private, with a very, very small fraction of that taking place over here in the public market. So just to give a short example over there, LinkedIn IPO'd a $9 billion valuation. $9 billion was captured by the private investors. It was subsequently bought by Microsoft at $26 billion. So the public market basically tripled their money, but the 600% that LinkedIn generated for its private investors is, of course, completely incomprehensible and incomparable to what the public stock did over there. So you can't wait till these technology companies hit the public markets. At that stage, it really is too late. You need to get in early, and you need to get in to make sure that you have exposure to this kind of asset class if you have a diversified portfolio. That being the case, what do we look for? When we invest in companies, we're really just looking for a well risk-adjusted structure where we could see that there's going to be ample upside, where we can make a lot of money, those 600, 700, 800% ideally, if we could do that, as well as having sufficient downside protection. Okay, so the way OurCrowd does this is kind of our six-point checklist. We make sure that we have co-sponsorship. We don't like to invest in companies by ourselves. We like to know that there are other investors, institutional, professional investors, that agree with our thesis, that give credibility to our thesis. Nobody likes to do things by themselves, so it's very important that we surround ourselves with good people. The second thing that we look for is traction. It doesn't necessarily have to be commercial traction. If a company has POCs, proof of concepts, if a company has development in their technology, if a company has filed for patents, whatever kind of traction we could see that the company is going somewhere is indicative to us that it's probably worth following that story and seeing how far we could push the envelope with them. The third is the team. Really, the operators are the most important component of any investment we and most VCs that I speak to ever talk to. Okay, you can have a great team and an average product, and the company will do very well. On the flip side, you can have an amazing product with an average team, and they're just never going to close sales, they're never going to go anywhere. The team really, that is who you're making your bet on, and it's the operators that are going to make or break your investment. The fourth is the size of the market. OurCrowd looks for huge, global, multi-billion-dollar markets. We're not looking for a niche product. Niche products could go elsewhere. We're looking for something that is hugely disruptive, that could have global rollout. The fifth is that it has to be a simple value proposition. If it's hard for us to understand, and based on our model, therefore, will become hard for us to communicate to the crowd on our platform, it's also not going to pass our investment criteria. And then for the purposes of this session, the most important really is these deal terms over here, which we're going to describe now. The deal terms is laid out in what's called the term sheet. A term sheet is also known as a letter of intent or a head of agreement. It's basically that skeleton structure that is going to lay out the foundations of what the final investment is going to look like. If there's any questions, I can't see you because of the lights, but please just shout out. Okay. So we're going to start by going through the economic provisions now. Everything that I'm about to describe is based on the fact that when we invest in companies, we take preferred stock. Today, if you have exposure in public markets, what you would do is you would be buying public stock. Public stock always is common. Common shareholders have no rights whatsoever. You could buy shares, you could sell shares if there's liquidity and the market provides for that. Other than that, you have no rights. When it comes to preferred stock, there are many, many more rights that, dare I say, are actually more important than the price that you pay for the shares and the valuation of the company. So the first component is really valuation. The way we value companies is, I guess, pivoted on these four very, very important levers that we could be pulling on: the valuation, the ESOP, anti-dilution, and liquidation preferences. All of these basically level out the value of a company in the way we give it and derive value from our investment. So if we start with that first component, the valuation, when we're talking about early stage startups, it's very difficult for this to become a calculated mathematical experience. It's hard to look at cash flows. It's impossible to look at net present values, and it just doesn't exist. Most of the companies that we invest in don't have these cash flows. They don't have these revenues that will make any type of meaningful calculation for us to actually back model. So what we do is look at some of the softer metrics, some of the qualitative, not quantitative metrics, and take in a balance between these two kind of analytical points. Really helps us zone in on what we think is a fair valuation. Now, some of that might be the quality of the team and competitive transactions that have occurred in the marketplace. It could be the technology and where we think the markets are driving. A huge factor is the public market and accessibility to capital. Today, we see that valuations are sky high because there is so much capital available in the market. And startups can really pick their choice by going to whichever investors are going to be writing those bigger checks at those higher valuations. Before I move on to ESOP, something else that's important to point out is that when you think of value of a company, generally what happens is a company has its financial and capital needs. Okay, if you've got a company that is creating some piece of hardware and they know that the cost of the hardware is going to be $2 million for the next year, giving them $500,000 isn't going to help them. Because all you've done is bought them 3 months of runway, you've funded an underfunded company, and in 3 months' time they're going to be knocking on your door and telling you that they haven't developed anything because 500 grand was nothing, they needed the full 2 million, and they haven't got any traction to justify another investment. It's incredibly important that you understand how much money a company needs before writing a check. On the flip side, you also want to know how much of that company you're going to be owning. Okay, and the way you derive this is by saying you have this pre-money valuation concept, you put money into the company, and subsequently you have a post-money valuation concept. It's a simple arithmetic calculation that the pre-money valuation, let's say, is $10 million. You invest $5 million in the company, the post-money is now 15. If you gave that company $5 million, you now own a third of the company, 33% of the company being the 5 million divided by that post-money valuation of 15. Okay, so that concept is going to become important as we go through more examples. Another point that we use over here, lever to really play around with the valuation, is this concept called ESOP, which is an employee stock option plan or employee stock option pool. This is a pool of shares that the company sets aside or allocates to its senior staff, or any staff really. It's up to the board and management to determine who's going to receive these shares. And these shares are there to incentivize senior management, to retain management, and to bring in people into the company. And the reason for this is twofold. Number one, startups generally lack financial resources. Okay, if you've got a senior person in R&D, they could most likely be making more money off the bat had they gone to Intel, Microsoft, Apple, anywhere else. in order to encourage them to come to your struggling small fund, underfunded startup, the way you do that is you give them skin in the game. You give them a kind of equity at that low valuation and say to them, as the company grows and as they bring value to the company and they create the real value to the company, their own shares in that company is of course going to increase as well. And then on the exit, they get the payout. So on the one hand, you're incentivizing the team, you're giving them skin in the game, and they become part of the mission. On the second hand, you also are retaining much needed capital resources by not having to compete with the salaries of some of the bigger firms out there. But the thing is, when you've got these ESOP plans, and let's say we're going to carve out 10, 15% of the company to give to your management, somebody has to be giving away that 10 or 15% to provide for that, right? You're still always going to have 100% of a company. So somebody has to take a haircut. And the question becomes, who is really going to be the ones that are giving away the shares to make management happy? And 9 out of 10 times, it's going to be the existing investors in the company, and it's not going to be the VC that's coming in post-fact and providing the capital. And the reason for that is no VC or no investor would ever give the company money knowing that the next day they're going to go and assign 20% of that value to employees, okay? So the VC would always mandate and demand that there's a lot of echo. The VC is always going to demand that the ESOP shares are allocated in a pre-money valuation. And therefore, that's going to come off the back of the existing investors, the founders, and previous shareholders in the company. So if we go through this, a quick calculation over here, a mathematical calculation, let's say that we as a VC have identified a company, we've allocated a 20 million pre-money valuation to that company, and we acknowledge that the company has already carved out 10% of all of its shares to management. But we feel that that's not sufficient. We think that the company needs at least 20% to be given out to management because it's young. They need to bring on a VP of R&D. They need to bring on a sales guy in North America, whatever it is, right? But we've worked out that we think that the right incentivization is 20% of the company. So we need to grow that pool from 10% to 20%. The way we do that is effectively by reducing that pre-money sticker price valuation, that 20 million, by the additional 10%, such that the effective valuation and therefore the share price that we'll be buying in at would actually be calculated based on an $18 million valuation, not the 20. So we can already see over here that playing with these employee stock option pools, we already could start moving the needle quite significantly with regard to the sticker price valuation. And this actually came up a few years ago within our portfolio. We had a company in the portfolio that went on to raise more money from a big fund. And everybody was high-fiving each other that they just got this new term sheet at a much higher valuation than the investment that we had previously done. And they emailed me with the good news to let me know that more money was coming in. We'll see an appreciation on the share price. What they didn't appreciate to realize is that the term sheet had such high stipulations with regard to the ESOP that although the sticker price was higher than the valuation that we invested in, the share price was actually below. And this is a trick that's very important to look out for. It's something that we do all the time. Sometimes we use it, sometimes we look out for it, but it's definitely something that VCs do use to their advantage, and it helps. It's one of the levers that helps to balance valuation. Unfortunately, there are no doors to this room, so feel free to just zone out of that. Okay, the third component is the liquidation preferences. Liquidation preferences is that term that helps protect. Hello? Liquidation preferences is that term that helps protect us in the downside. When I said before that there needs to be ample upside but also mitigate the downside risk, that's all summarized in a liquidation preference. And a liquidation preference effectively says that there are circumstances in which you as a preferred shareholder can extract. Come on. There are circumstances in which you, as a preferred shareholder, can extract your There are circumstances in which you can extract your capital from a company even when the company actually doesn't perform. You could have a company that is headed south, okay? There's a few residual assets in the company that can get saved, salvaged, and distributed. You could actually extract that before any of the common shareholders. And I'm going to describe that example now also on the next slide, mathematically, just before we do that, there are two types of liquidation preferences. The one is what's called non-participating preferred. Non-participating preferred effectively means that if you decide to use your liquidation preference in the context of your preferred shares, you will get your money out before anybody else gets their money out. Guys, you'll get your money out before anybody else gets your money out. You'll get your money out before any of the other investors can extract any of their capital. So these non-participating preferred preferences work as follows. You effectively get, as a preferred shareholder, to take your money out, and then you go home. If you put $1 million into the company, you take your $1 million out of the company, and that's the end of your return profile, okay? But you also get these participating preferred. And participating in preferred works as follows. It's not that you get your preference and then you leave, it's that you get your preference and you continue to participate in future distributions of the company based on your ownership. So I'll give you an example. Let's say I invest $5 million at a 15 million pre-money valuation, okay? So based on the math we described before, 5 at a 15 pre equates to 20 post. My 5 at the 20 equates to a 25% or a quarter ownership of that company. In a non-participating preference, I'll get my $5 million and that's the end. In a participating preference, I'll get the $5 million back. Let's say this company sold for $100 million. After the 5 comes out, there's still residual $95 million. I'll be able to also take 25% of that residual amount. So participating preferences are incredibly beneficial for VCs, although they're not very common, because they're seen as double dipping, it's seen as quite draconian and against the founders, and in a competitive landscape like we're in today, where there is so much available capital, founders really do get to choose where they're going to be taking capital from, and in those kind of terms, generally you're not going to get a deal done. But again, it really does depend on where you invest in, what the climate is like, and what the environment is like over there. And then finally, I guess, as a subsection of these participating preferred, you could get a capped participation. And that effectively is this compromise position between the two, in which the company will say, you do get your capital and then participate, but let's stop that at, let's say, 3 times your money, 4 times, 5 times your money, whatever you negotiate. And at that stage, you then stop to take your participation and you convert to common stock and you only take your piece of the puzzle. So these over here are very, very important terms. When we invest in companies, we will always mandate that there is a participating preference, that there is a preference, I beg your pardon. If we could start with participating, that's great. If we can't, which is realistically most of the time, we will take a non-participating preference. But this is the most important term with regard to your downside protection, to make sure that if things aren't going well, you are protected and you can get your capital out of the company, despite the fact that there's not enough capital to make all the shareholders go home happy. So this was actually a real example that we were looking at a few months ago, which was pretty interesting for us. We had a company that we had valued actually in scenario B at $110 million, and we were looking to raise $15 million for them. So again, the post money was going to be $125 million. We would have owned 12% of the company, and this had a 2x liquidation preference, meaning that the first 2 times the 15, the first $30 million, we would have taken before anybody else received a dime. So although we invested at this high valuation over here of 110, had the company sold for just $30 million, we would have made 2 times our money and everybody else would have got 0. Okay? The second scenario that we were discussing with them was that we reduced the valuation significantly, therefore our ownership increases significantly, but in this scenario, it was only a 1x preference, meaning that the first $15 million comes to us, okay, and then after that, we start to distribute to other shareholders and other investors in the company. Now, this was a non-participating preference, and the break-even analysis for us was at the $150 million mark over here, in which was really our point of indifference on what happened to the company. But up into an exit of $150 million, we actually would have preferred to take scenario B over here, owning less of the company but having a better liquidation preference, then on the higher end of the spectrum, where we would actually have preferred to have taken the higher valuation because it would be more likely for us to have converted to our common stock and taken the piece of the pie as opposed to taking our preference. So this comes up all the time, and again, you can see over here how these liquidation preferences play into the conversation of valuation, because when you come into a company and you're trying to give them those guidelines on how to value their company, this kind of aggression, coming with a 2x, effectively saying to the company, we're going to take a chance on you. We don't think you're worth what you think you are, and to mitigate against that, we're going to take a high preference, as opposed to this kind of valuation, which is very much aligned with the founders and with the rest of the company. So again, that is our third component, how we play with startup valuation and how we try balance that. And the final is called anti-dilution protection. Again, you will see this in all of our term sheets. Anti-dilution protection is that term that comes to reprice your previous stock based on the fact that the company issues shares at a lower price than which you bought at, okay? The first and the most easy to understand is called full ratchet. If I buy shares in a company at $2 a share, and then you come and buy shares at $1 a share, they will reprice my stock at $1 a share, effectively giving me twice the amount of shares I previously had. And the purpose for that is to effectively come and say, again, you thought that you were worth $100 million. We're prepared to go down the route with you. We're prepared to invest on those bases. But if you've proven that you can't grow value at that and you have to raise money at a lower valuation, it means our thesis was right, yours was wrong, and we want to get compensated for that. And the way we get compensated is by saying, go back retroactively and reprice our previous stock. Okay, that's full ratchet. Much more common is what's called broad-based weighted average anti-dilution protection. And this provision is kind of like a broad-based weighted average based on how many shares in the company, how many we've bought, at what prices, etc. And it's kind of a meet in the middle. So you don't get the full revaluation of your stock, but you do get a significant revalue over there. That's with regard to valuing companies. That's with regard to assigning, that share price and that sticker price. How we kind of look at those four incredibly important levers that we could be putting on coming up with a valuation that makes sense for us as investors. And a lot of that refers to the notion of downside protection. We don't want to overpay for a company, and if we are, there are mechanisms built into that valuation for us to mitigate against that with regard to the anti-dilution and the liquidation preferences. But on the flip side, where is that ample upside I was talking about at the beginning? The upside comes in this over here, which is called the preemptive rights. Preemptive rights is a legal right that you as a preferred shareholder purchase to continue to invest in the company in future financing rounds such that you do not get diluted. If you own 10% of a company today and somebody comes and puts more money into the company and buys more stock from the company, your 10% is not worth 10% anymore. It goes down 8%, 7%, whatever it is. In fact, I could tell you today, founders on day one own 100% of their companies. If they get to exit, anywhere between 6 and 12% is absolutely normal. So dilution is really part and parcel of venture capital investing, on any investing really, that as a company issues more stock to future rounds of shareholders and investors, you'll find that the previous investors own less and less. So the preemptive right is a legal right for you to participate in future rounds to guarantee and to offset with additional capital to guarantee your ownership in a company such that you do not get diluted below a threshold. So how that works is, let's say I own 10% of a company, and now a company goes and wants to raise $20 million. If I invest 10% of that $20 million, $2 million, at the end, the 10% that I've bought in the new round will offset the dilution of the 10% I owned in the previous round. And at the end of the story, I'll continue to own my 10% in the company over there. So preemptive rights are incredibly important. And this is something we continue to try to educate our crowd, and we try to promote as much as we can, which is, as soon as you've identified companies in your portfolio that are starting to show signs of breaking away from the crowd, that they become de-risked either on the technological front, de-risked on the commercial front, de-risked on the personnel front, and they've started to attract better and better capital and better resources. These are the companies that you want to start putting more and more resources into to make sure that your winning companies win big for you. Because at the end of the day, if you have at the end 1 or 2% of a very successful company, you haven't really done anything. That's not portfolio management. That's not portfolio optimization. And this is all built in this concept called the power law. There is a misconception that venture capital works in a linear platform, in that you've got the number of deals that you've invested in, and some deals will perform very poorly for you. You'll write them off. Others will be Facebook and WhatsApp and LinkedIn. And across the spectrum, you're going to find everything else. That is actually not the case. This is a very big misconception. Really, it works according to the power law. And the power law states that a very small percentage of your portfolio would outperform so fundamentally different to the rest of your portfolio that the profits and the gains that you make from these companies not only will do well for them, but they'll actually offset the losses that you see in the long tail of all the other companies in the portfolio. Venture is, of course, one of the most risky asset classes out there. If you do not have a diversified portfolio, you are almost guaranteed to lose your capital. It has to be based on a diversified portfolio of multiple companies. There's been a tremendous amount of studies about this, which hopefully I'll show in a few slides, that actually shows the ideal portfolio size. But this over here really does. This really does come to highlight the importance of preemptive rights and making sure that you do identify where your winning companies are coming from and how to maximize on them. Okay, changing gears completely, talking now about convertible notes. Convertible notes are not equity, at least not initially. A convertible note is a debt instrument, okay, that has an equity kicker to it and has the ability to convert to equity such that you could also take advantage. Come. Guys, can I have the other mic back, please? Our next company we invest in is a microphone company. It actually is. It actually is a microphone company. We're in deep diligence. They have both audio and optical sensors in them and allows you to not only take audio, okay. It's going to be very awkward if I try to put this in my pocket. Convertible notes. So these are debt instruments initially. They do have an equity kicker. And the way it works is that when you invest in a company, there are circumstances in which you prefer the comfort and the security of being senior debt on a balance sheet as opposed to being equity. The reason for that is that when a company distributes assets, debt holders are always going to be able to extract capital assets out of a company before equity holders. So the way a debt instrument works and the incentivization for investing in debt is twofold. We will come to a company and say we're prepared to provide you with the debt so long as that when it does convert, either after time or after a kicker, for example, the company does raise an equity round, a significant equity round that we think is meaningful for the company, then we're going to convert our debt into equity at the lower valuation of either the discount or a cap. A discount effectively is saying whatever your new shareholders are buying at, we want to have a discount to that. If they're buying at $1 a share, we want to buy at 80 cents. If they're buying at $3 a share, we want to buy at $2, right? Or depending, oh my God, whatever it is, right? But you're going to have these circumstances in which you can negotiate with the company what a meaningful discount is for you over there to give you the upside ability to also optimize on the fact that you've taken risk by lending a company debt, okay? The other component, though, is a valuation cap. And that is you come to a company and you say, we prepare to give you debt, but when it converts, under no circumstances will that debt convert at a valuation of more than $5 million or $20 million, okay? So if they then go and use your capital and they create tremendous amount of value to the company and the technology, and then they go and they've used your capital to really elevate and boost the valuation of the company, and they raise money at $100 million, you don't want to be the guys that are just getting your 20% discount and you have to pay at $80 million when they're only there because they use your capital. So you have a cap on that and you say the cap is 20 million. If you raise it 100, fantastic. But we are converting our debt at a valuation effectively of 20 million, okay? Which is a fifth of the price. It's effectively an 80% discount on the equity. Okay. Another consideration, another very important term that we have in all of our term sheets is the ability to convert preferred shares into common shares. As I said before with regard to the liquidation preferences, your preferred shares have the ability to extract their capital, but if they're non-participating shares, you'll get back your $2 or $3 or $5 million check, but that's the end of your participation. You don't have any further upside. So in those circumstances, we'd far prefer to own common stock and take a piece of the pie then take what our initial check was, right? Even if it was a factor of 2 or 3, whatever it was, there are circumstances in which the upside is so high, we'd rather take a piece of the pie. So let's go through a short mathematical example here. Let's say that you invest 5 at a 15 pre, so again, that comes to a 20 million post-money valuation, in which we own 25% of that company. If the liquidation terms were 1.5x the capital that you invested, doesn't have to be 1.5, okay? But in that case, the preference that you'll take will be your 5 times the 1.5, you'll get back $7.5 million. But if you convert it to common, you'd rather take back the 25% of the full 40, which is $10 million. So you'd rather optimize to just take your common stock and leave the preference. Now, if you had a participating preference, that obviously would be the best, in which you first get your 5, and then you'll take 25% of the residual 35 million. Okay, so that's really the economic provisions in a term sheet. These are the items that we make sure we check the boxes on every term sheet that we look at. The other side, and this is of no less importance, is actually the control provisions. The control provisions come and eliminate any ambiguity. They eliminate any type of issues that arise in the future at their very onset. Okay, these are the control provisions that provide you with board rights, with information rights, with a right of first refusal, with protective provisions. We had a company in which one of the founders was able to find a secondary shareholding purchaser and wanted to sell all of his shares in his startup to a third party because he needed liquidity. So he, on the one hand, had no problem cashing out. He had no skin in the game, no incentive to come to work the next day, and we had a very large ownership in check there. So that protective provision will come and allow us to block that transaction, and these are very, very important for us as well to make sure that that any future issues that arise have already been pre-negotiated out, and there is no room in the heat of the argument to reopen these discussions. Okay. I mentioned before the importance of diversification. So a study that was done by Horsley Bridge, which is a limited partner in dozens and dozens of funds and therefore has exposure to hundreds and hundreds of companies, has found that the right number for a portfolio of startups, and again, this has to be contextualized into the stage of the company, is at about the 25 company mark, which is a relatively large portfolio. Okay, if you have a small portfolio, you've built out a very, very small individualized company by company base, unfortunately, the statistics are you're not going to return anything on those. As you get into fund products, and this really was the thesis for why OurCrowd is now taking such an aggressive stance on funds, and as John mentioned in the previous session, we have so many funds and we open in so many funds, is because we really are trying to provide a thoroughly diversified portfolio to our investors, okay? And this has been the thesis for many of our fund products like OurCrowd 50, which is an index fund, and OurCrowd Squared, which is an opportunity fund, which again we're going to elaborate more on in the next session. And the final thing I want to talk about is this concept called the J-curve. Many of your investors, I could see by the color of your tags over here and faces that I recognize, have spoken to me and said, Shmuel, I invested 3 or 4 years ago in the portfolio and I've lost money. Why should I continue to invest? And the reason you should continue, well, the reason that has happened is as follows. In VC, you have this concept called the J-curve. And the J-curve comes and says as follows, that your bad companies, your weakest companies in the portfolio, are going to be the quickest companies to die first, the quickest companies that are going to be apparently impossible to finance, and therefore, you're going to start impairing the carrying value of those investments early in the life cycle of your fund. But it's those more successful companies that have well-bolstered balance sheets, that are able to actually continue operations running off their own working capital, that are going to slowly grow their share value, not through doing immediate rounds and picking up small financings along the way, but they're really going to try wait that out as long as possible to show the most amount of growth to maximize on those fundraising rounds. So what you find is that your worst companies die soon, and your better companies just take that much longer before they break even and then start to actually accrue real value to the portfolio. And we've seen this now numerous times across individual LPs within the portfolio, and actually also across the GP as a whole, that as we let time go on, and as we see that these companies are starting to show real value and create a tremendous amount of wealth, the companies are starting to now actually change the dynamic of our portfolio. And as John mentioned, we now have 4 companies that are worth over $1 billion each, and we have over 30 companies over $100 million each. So that's just the nature of the beast. The trend actually over the last few years is that this cycle is getting longer and longer. Companies used to IPO or sell out after 4 to 6 years. We're seeing that today it's anywhere between 9 and 12 years. So as that is taking longer and longer, the life cycle of these funds are taking longer and longer. And that's just the nature of the game over here, that liquidity is not going to come immediately, but when it does, hopefully it's going to come in a much more meaningful way. And despite the extra time, the IRR should still be much more impressive. So that, I guess, finalizes the formal part of the presentation. I'm happy to take more questions. I did also prepare some homework reading for you. It was originally prepared for digital version, so you can't really double click on anything. But if you do go to my LinkedIn account or to OurCrowd.com, you can download this. Anybody that's interested in playing around with cap tables, going through some of the exercises with regard to anti-dilution, preemptive rights, exit scenarios, there's a pretty cool dynamic cap table in here in Excel for you to play with to really try zone in on those skills. If you take nothing out of this session, please remember the following. Valuation is one very, very small component when it comes to looking at a startup. If you don't contextualize what the liquidation stack is with regard to their preferences, if you don't look at the protection you have on the anti-dilution, how much of that value is actually being assigned to future employees, you're not going to get the full picture of what a valuation is. And this is something that I'm trying to educate more and more people about, which is do not get stuck on the sticker price. It's a very, very small, although important, small and certainly not final consideration that you should be looking at before you do or do not make investment. The second thing is you have to diversify. If you're not diversifying, then the odds are really against you, and the nature of the beast is that you're going to lose your money. The third is that it's going to take time. This is a patient, slow game. Okay, it's not like public stock where you have an ability to sell. Once you're in for the long shot. And the final thing is you have to look out for your follow-on rounds. Because as soon as you see those companies that really are starting to show signs of breaking away from the crowd, showing those signs of success, that's the ones that you want to start putting your finger on and saying, okay, fine, all those other companies I tried, they didn't really necessarily work out, but this is the 1 or 2 companies that I'm really going to follow through to exit. And the final thing is that if you are an entrepreneur sitting here in the audience, you are not expected to know all of this. Okay, if you're a successful entrepreneur, you will maybe do this 3 or 4 times over the next 5 years. So if you're looking for advice, please come see me or anyone of the OurCrowd staff. We'll be more than happy to assist you to really try to create the best term sheets, the best terms to help provide you with what you need to capitalize your companies and hopefully create a unicorn. I'll be here for the next 20 minutes if anyone has any questions. Otherwise, I really do appreciate you coming today and looking forward to the next session, which is going to be on following your bets, those follow-on rounds, really zoning in onto that and making sure we really do understand the trends and where VC is headed today and what the markets have in store for us. Thank you very much.